Hello and welcome to the UBP podcast. I'm Peter Kinsella, Global Head of FX Strategy at UBP, coming to you live from quarantine, where it looks like I'll be spending the next 3 weeks. And I'll take this opportunity to wish all of our listeners a safe and hopefully speedy return to work in the weeks and months ahead. Today we're going to look at the outlook for gold. Here at UBP, we changed our outlook on gold in June of 2019. At the time, we thought that growth and inflation dynamics around the world were deteriorating. And as a result of this, central banks in advanced and emerging markets shifted to a dovish stance. The new stance included rate cuts and eventually included a resumption of quantitative easing policies. The coincident nature of global easing from the likes of the Fed, the European Central Bank, the Reserve Bank of Australia, and emerging market central banks in Turkey, Russia, Brazil, and India led to a swift rise in gold prices. Gold rose from levels of around $1,200 per ounce to levels of around $1,500 per ounce by the end of 2019. Investors were quick to increase their gold positions. CFTC data indicates that investors increased their net long gold positions to multi-year highs over the course of the last 9 months. The positioning data also shows that investors use significant quantities of leverage to increase the potential returns from higher gold prices. This was not the only reason for gold prices to rise. There was also a qualitative change in how central banks were easing, which had constructive implications for gold. The imposition of negative deposit rates was a really interesting development for gold. At its September 2019 meeting, the European Central Bank reduced its deposit rate by 10 basis points, bringing it to minus 0.5%. The imposition of negative deposit rates, where depositors are charged to hold their deposits, means that gold has become a more interesting store of value. Indeed, storage costs for gold are now cheaper than leaving money in the bank. So far, most retail banks have refrained from passing on the costs of the ECB's negative deposit rate policy to customers. However, the large decline in net interest margins from most retail banks means it's only a matter of time before they pass on these costs to their retail customers. When they do, a large number of retail investors will look at gold as a means of storing some of their wealth. The onset of the coronavirus, known as COVID-19, has had a dramatic effect on gold prices. Gold surged to levels of around $1,700 per ounce as equity investors sought the safety of the yellow metal when global risk aversion increased notably. However, the gold price rally did not last for long. The huge increase in risk aversion led investors to sell their gold holdings in order to provide margin for underperforming equity positions. Gold prices subsequently dropped dramatically to lows of around $1,500 per ounce in the space of a week. It's no surprise that gold volatilities also increased notably. 1 month implied volatility surged to levels of above 40%, which is a huge move considering that only months before this, the same volatilities traded at levels of around 10%. There was a precedent for this type of price action. During the global financial crisis in 2008, gold prices fell from levels of around $1,000 per ounce to levels around $700 per ounce. And that down move happened basically at the same time as global equity indices plummeted by nearly 50%. The recent gold down move was likely exaggerated by difficulties with risk parity funds, which experienced large losses in recent weeks and most likely had to sell gold exposures to raise funds for margin requirements and possible redemptions. We think that risks are now firmly on the upside for gold, and we think that gold can easily reach levels of around $1,800 per ounce during 2020. There are a number of reasons for this. First, central banks have committed to doing whatever it takes to prevent widespread corporate defaults. In the US, the Federal Reserve has committed itself to undertaking open-ended quantitative easing policies. In the Eurozone, the ECB has also stepped up to the plate and has pledged to buy around €750 billion of government and corporate bonds. The ECB has also said it would ignore the theoretical constraints posed by its capital key, meaning that it now stands ready to buy more Italian debt if necessary. Because central banks cannot reduce interest rates any further, and government debt levels are absurdly high, it means that central banks may begin to consider extremely unconventional monetary policies. Central banks could begin to slowly monetize debt, which they are already implicitly doing in some parts of the world like Japan. Alternatively, central banks could move to engage in helicopter money policies, which would act as a stimulus measure in the current environment and help to kickstart national economies when the quarantine measures and national lockdowns come to an end. Remember, a central bank is the only financial institution which can recapitalize itself. Unconventional problems need unconventional solutions, and we believe that it is not impossible to see a scenario where the fiscal and monetary authorities agree on a one-off monetary stimulus in the form of a helicopter money drop. Gold prices would skyrocket in such a situation. It's worth bearing in mind that this is of course the ultimate taboo as far as central banks are concerned. However, what the last years have taught us is that central banks will go to any length to keep the show on the road. The options market is worth looking at in this regard. The volatility surface for gold options, which measures the expensive options over longer maturities, shows that investors are buying low delta gold calls. What this means in simple terms is that investors are buying deeply out of the money gold calls, which will benefit from a large up move in the gold price. Clearly, investors are voting with their feet and they're buying tail risk protection for potentially huge gold price appreciation. The bottom line is that we think there are continued upside risks for the gold price, even following the large increase we've seen since the last year. Thanks for listening.